folks, welcome back to Motivated Investing. The past 12 months have seen a major shift in the way institutions look at digital assets. The economic effect of the COVID-19 lockdowns in spring of 2020 caused central banks to engage in economic stimulus and lower interest rates to zero. And the narrative surrounding Bitcoin became that of digital gold, a good hedge against inflation. This was further strengthened by Bitcoin's halving in May 2020, whereby the supply of newly mined Bitcoin was cut in half, making it less inflationary than gold. A June 2020 survey from Fidelity Digital Assets found that 36% of US and European institutional investors were already investing in crypto assets. Those institutions included high net worth individuals, financial advisors, family officers, crypto hedge and venue funds, traditional hedge funds, endowments, and foundations. Especially in the latter half of 2020, a number of large institutional investors announced purchases of Bitcoin, as shown in the timeline graphic below. Curiously, while Bitcoin garners ever-increasing attention from institutions, interest from ordinary retail investors never passed its 2017 high, according to Google Trends. It has never been easier for institutions to get exposure to crypto. Making a first foray into crypto investing can be intimidating prospect, but the reality is that it is easier than ever to achieve a crypto allocation for both retail and institution alike. Firms like MicroStrategy and Tesla chose to achieve their Bitcoin allocation through direct ownership of crypto, purchased and custodied through US Prime brokerage services. Those who prefer not to own crypto directly, however, can choose from several crypto-backed ETPs now trading on stock exchanges in Canada and Europe. Although the US SEC has yet to approve a crypto ETF, Grayscale has provided an investment avenue for US institutional investors via a trust structure. The Grayscale trusts take on new investors via private placements, buying cryptocurrencies in the background to achieve the underlying backing for the shares. Alternatively, for institutions comfortable holding derivatives, futures for both BTC and ETH can be traded on the Chicago Mercantile Exchange. There are also a few options to purchase stock in crypto companies. Coinbase went public on the NASDAQ via a direct listing in April, and its stock provides a way to bet on one of the largest brokerage exchanges in the space. Other notable public crypto companies include the crypto miners Cardone and Riot Blockchain, the ETP provider CoinShares, and the holding company Galaxy Digital. While this report focuses on institutional investment, it is worth mentioning that opportunities for retail investors to purchase crypto now include PayPal, Venmo, Cash App, Revolt, Trade Republic, Robinhood, eToro, and more. For retail and institutions alike, whether from the US or global, it has never been easier to determine how to invest in crypto. Breaking down recent institutional inflows in crypto. Grayscale led the way in 2020. The prevailing narrative surrounding institutional inflows has been centered around the Grayscale trusts, which offer new institutional investors access via private placements. These trusts provided an easy answer to institutional investors wondering how to invest in crypto, and Grayscale reported higher inflows for every subsequent quarter of 2020. By the end of 2020, Grayscale had raised over $5.7 billion across its family of investment products, more than 4 times the inflows that received from its inception in 2013 to the end of 2019. Further inflows in Q1 of 2021 combined with the continued rising price of Bitcoin grew Grayscale's Bitcoin Trust to $36 billion under management as of May 5th, 2021, with another $8.7 billion in the Ethereum trusts. Grayscale is one of the fastest growing asset managers of all time. The rise of exchange-traded products, more traditional exchange-traded products, have also seen significant inflows. ETPs are springing up in Canada and Europe quickly attracted hundreds of millions from investors wishing to get crypto exposure without the challenge of managing custody of their assets. According to Bloomberg, as of May 5th, 2021, there are $6.9 billion in Bitcoin ETPs and another $2.4 billion in open interest in CME's Bitcoin futures. The largest ETPs for both Bitcoin and Ethereum are the trackers from CoinShares, which have traded for many years on the NASDAQ Stockholm Exchange and have several $billion under management. While these trackers are synthetically replicated using both direct ownership of Bitcoin and also derivatives, they do offer shareholders the ability to redeem their shares for the underlying crypto assets, and the funds have been audited to prove their 1:1 replication of the underlying assets. Further demand may soon come from Germany, where new legislation passed in April of 2021 allows German special funds to invest up to 20% of their assets in crypto, creating new avenues for institutional investment in Europe. The ongoing wait for a US ET, the next major step forward in the crypto ETP landscape, would be the long-awaited approval for a Bitcoin ETF by the United States SEC. The Winklevoss twins filed a first application for such an ETF in 2013, which was rejected by the SEC in 2017. Many Bitcoin ETF applications have been made since then, only to receive similar rejections. Grayscale has also stated its desire to convert its products from trusts into ETFs, which would then become redeemable for the underlying asset and trade at the fairer price. Institutional investors wishing to purchase crypto via exchange-traded products will have to wait for a US ETF and make do with existing ETPs. The evolution of digital assets. The recent entrance of major corporations and institutions into the crypto ecosystem signified an advancement along the adoption curve. Crypto has clearly grown beyond the retail investors who pushed Bitcoin to its 2017 heights. Now, accredited and institutional investors are learning how to invest in crypto. US banks have been given the regulatory go-ahead to offer custody of crypto assets, and core banking software is being upgraded to facilitate crypto investing by private and investment bankers. However, the low adoption from family offices and pension providers shows that we still have a long way to go before cryptocurrencies and other digital assets reach the level of acceptance associated with equities, bonds, or real estate. The largest of institutions will not be able to enter the crypto market in a meaningful way until there is more comprehensive regulatory and tax guidance, less volatility, and more liquidity in markets, and the ability to cheaply insure large portfolios of assets. Central bank digital currencies. A development that ran parallel to the cryptocurrency space in 2020 was the testing of China's digital yuan and the beginning of serious discussion around central bank digital currencies in Europe and in the US. While it seems unlikely that countries will begin to move to a Bitcoin standard of money or use their sovereign wealth funds to enter crypto in the near future, governments are now paying attention to cryptocurrencies and thinking about their role in the future of digital money. Tokenization of existing financial assets. Perhaps the largest development yet to take shape in the digital asset landscape is tokenization, whereby existing financial assets are put onto blockchain in the form of security tokens. Tokenization is set to create massive change in the way we account for and trade assets, both digital and physical, as ownership of digital assets can be more easily transferred, fractionalized into smaller shares, and traded with more liquidity. Tokenization of real estate assets, for example, would do away with listing agents, real estate attorneys, title companies, and notary signing agents, as smart contracts and blockchain ledgers would create immutable records of ownership and transaction. Research from the World Economic Forum, Deloitte, and McKinsey project that up to 10% of global gross domestic product will be stored and transacted with the help of blockchain technology by 2025 till 2027. A 2018 study from Finoa estimated a tokenized asset market of $24 trillion by 2027. In 2020, Finoa custodied an asset-linked token representing a German DAX share, which was created by Bankhaus, Schick, and Cashlink Technologies. We've already taken the first step in what we predict will soon be a massive trend towards tokenization. Conclusion: whether through a crypto ETP, a prime brokerage trading desk, or an agreement with a developer team, institutional investors of all kinds are entering the blossoming crypto asset space. An asset class once seen as risky and confusing has become an area of opportunity, and institutions are keen to find their place in this growing industry. Thank you for watching. Don't forget to subscribe to the channel. See you in the next video.